The Nigerian consumer goods sector faced a turbulent 2024, grappling with inflationary pressures, forex volatility, and reduced consumer spending. Despite these macroeconomic headwinds, companies demonstrated resilience through strategic initiatives such as pricing adjustments, portfolio expansion, and optimized distribution networks. This conversation explores the outlook for Nigeria's consumer goods industry in 2025. And joining me for this, I have Oluebube Nwosu, Consumer Goods Analyst, Vetiva Capital Management. Thank you, Oluebube, for joining me today.
Thank you for having me. It's a pleasure.
Same here. Now, talk to us. How would you describe 2024 for an average manufacturer in the consumer goods sector?
All right. For the average manufacturer in 2024, it was a tale of having to jump hurdles and having to jump those hurdles because you also have to be in business. Again, for the average manufacturer, it might be a bit difficult to use an average figure across the board because the impact of different things will be different for different sizes. Take for instance, energy, which is a primary legacy cost for manufacturers, had an outsized impact on the smaller manufacturers as it took a bigger chunk of their cost profile. As such, we saw the Manufacturers Association of Nigeria complaining at different points that certain businesses will literally go out of business given the cost profile of energy. However, it's not going to have that kind of impact for the much bigger companies, but it did affect some of their capacity because they also have to ensure that their cost profile is not being it's not ballooning out of control. But when it also came to distribution, you would also have different impact on different companies. For companies that had localized their distribution chain, they were able to stay resilient. For companies that had really they had market control, were also able to stay at top of their game. But those in between had a tougher time, adjusting and readjusting because they had to keep changing prices. And if you don't have distribution on lock and your prices are changing very quickly, you might lose the market actually. So every single manufacturer had to be on top of their game in 2024 because it was really a bumpy year.
All right. So now I'd like us to speak to specifics now. We're talking about consumer goods. So we understand the role of energy prices, inflationary pressures, and even forex volatility on, these people, consumers and manufacturers alike. And just like I said, I'd like you to speak to us about the impact it had on the various companies, the listed companies now, and how some of them were able to sort of navigate these challenges and emerge profitable.
All right. So the first part is the biggest impact we saw was on the sugar space. And this was because sugar saw a level of inelasticity during the year that wasn't seen in the previous year. Yeah, and not just that, it was also the fact that the FX volatility must have taken some of the sugar manufacturers by surprise. So while they had really impressive revenue gains, the cost of sales was a lot more significant. And this is because we still have to import lots of sugar. However, we saw them try to reduce their operating expenses just to enable them to have sufficient cash flow for other parts of their operations, which was a very good move. But we saw major in the moving over to the brewery space. We also saw FX impact them significantly. However, we saw also huge respite that came in from the rights issues of international breweries. We also saw the same for Nigerian breweries. Then we saw share sales in Champions Breweries. We also saw share sales in Guinness. And what this tells us is that investors have come to understand that these industries are very critical in the economy, that these businesses are also market leaders, and long term, they are still good to go. However, this period whereby the headwinds have impacted them significantly, it's definitely going to show in their operations and in their results, but these still remain solid brand names with a solid product catalog. And finally, for the food space, the food space had in a sense the best performance. This is because they were able to get more of their inputs locally, unlike the breweries and the sugar industry that have to do more imports generally. And then for the food space, we saw better performances from Unilever, which has a higher local content in its production. This is very important because the naira depreciated significantly, especially in the first quarter of the year. And by the end of the year, we're around the 1,600 levels. But we had closed 2023 around 900 naira levels. So if you have to import more of your inputs, it's definitely going to affect not just your cost of sales, is also going to affect ultimately your profits, as well as your net finance expenses, because you also have to now allocate more naira to settle your foreign obligations. So we saw the best performance from Unilever. We saw more decent performance from Guinness, especially during the share sale agreement. We saw volatile trading in Nigerian breweries. We saw renewed optimism in international breweries towards the end of the year. We saw a Dangote Sugar Refinery, we saw a decline majorly because of the SEC not approving the merger, and so people who had bought into the stock based on the merger price were selling off the stock as well. So we saw that mixed performance across the board, and it was just investors basically looking at what their thesis is around investment.
All right. I mean, I wish we had the time to break down the food sector, because there's a lot to say about whether it's FMN or the other two you talked about. Now, coming to, some of these things, some analysts have actually said the negative effects of these current reforms will sort of diminish from this year, 2025, while their positive impacts will then begin to emerge. Now, what are these positive impacts and how soon will they materialize?
All right, so first, when we look at FX, for instance, so when the FX rates, the goal of the FX rate unification really is to ensure that there's stability in the market and there's availability. This really helps for manufacturers to plan their businesses. So it's a given now that they have higher cost profiles. That means that the products are more expensive in the market. But what would really help is that the prices will now stay stable. Yeah, the prices will no longer be as volatile as they will no longer move as in a volatile fashion as you've seen them move in 2023 and 2024. But then it's much more stable. That means that these companies can actually raise fresh investments, because they can tell their investors, this is how much we spend to produce this product, this is how much we sell it, this is how many we expect to sell in a year, and this is how many we expect to sell in 5 years' time. When it's clear and dependable, then they can raise more investment. If they raise more investment, they can also employ more people and grow their businesses. So it becomes positive for the owners, the investors, the employees, and the economy at large. That's more how you can think around what should be the positive sentiments following this as well. While the negative part that's supposed to drop is the fact that the volatility is now gone. The opacity in the market is also significantly reduced, and things are a lot more clear for people to actually work and plan with.
Well, talking about the opacity in the market, are you talking about the Forex market?
Primarily the Forex market.
All right. Now, talking again about this particular sector, that's the Consumer Goods Index. It's finished the year with a year-to-date gain of 54.44%, behind only oil and gas and insurance. That's based on the 5 indices that we track in-house. This does not necessarily mirror real-life experience of the sector, because if you ask me, that sector was one of those that reported Forex losses and all of those things. Banking, for instance, they're talking about Forex gains, but here, this particular sector comes before banking. So talk to us about these dynamics.
All right. So what we saw was a mix of investor sentiment based on corporate strategy, or what you call corporate disclosures, amid the general macro headwinds. Not also forget that the sector started the year on a low note, meaning it had ended 2023 on a lower note, and so people were already saw that some of these stocks have gotten to a price that is below what they consider their long-term fair value. Then when we go into specifics, Flour Mills, for instance, announced during the year, the parent company announced during the year an intention to take over minority shares, and they put out the share price of about 70 naira. So people began to trade in line with that, and we began to see Flour Mills rally significantly. And Flour Mills is a big cap stock. If it moves, the Consumer Goods Index moves. So when we started seeing the stock moves to 40 naira, to 50 naira, to 60 naira, and then they had the shareholders meeting, and during the negotiations, they finally agreed for 86 naira, which pushed the stock even higher. By the time the stock stopped trading on the 16th of December, it was already at 81 naira. That was about 100% gain, if not more, during the year. This also translated to in some subsidiary companies such as Northern Nigerian Flour Mills, as well as Honeywell Flour Mills. And these are mid-cap. Honeywell is a mid-cap company. Northern Nigeria is a small-cap company. So all of this contributed positively to the index gain for the year. Towards the end of the year, we also saw the international breweries, especially, and Nigerian breweries. We saw them begin to pick up again, because people had now realized that, well, their parent companies are foreign entities were able to deploy sufficient capital to cover up for the previous losses. That means that they have a long-term positive view towards the market. So it only makes sense for local investors to actually, come in as well. And not to forget that these companies had increased their capitalization during the year. International Breweries raised over 500 billion, and Nigeria Breweries also raised over 500 billion. That's about 1.1 trillion, raised during the year, which I think, and then another year we're now seeing them make in previous gains. Right. So International Breweries closed the year about 38% higher. So when you do that number on such, big cap companies, it's definitely going to, boost the numbers for the EX.
Absolutely. In 30 seconds, what's your outlook for the sector?
For the sector, in the coming year, what the sector, we're looking at stabilization of macro headwinds, that is inflation, tempering a bit, FX being much more stable, which is the major one for these companies. And when that happens, we intend to see them have mild recoveries in their margins, gross margin, EBIT margin, as such, be able to turn mild profits for the year to give us single-digit PAT margins.
Thank you so much, Oluebube Nwosu, Equity Research Analyst, or we can say Consumer Goods Analyst at Vetiva Capital Management. Thank you for your time on the show today.
Thank you for having me.